You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, that music means it's time once again for Options Bootcamp, the program here on the Options Insider Radio Network, where we break down some interesting options concepts and tell you how you can incorporate them into your portfolio. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call the Options Insider Radio Network. Quite a few programs on the network, up to 13 now, I do believe, at my last count. Where can you find all of that goodness, as well as many, many archived episodes of Options Bootcamp? Well, of course, theoptionsinsider.com. Click on the Insider Radio Network tab, and you're pretty much off to the races from there. You can download, you can stream till your heart's content. And of course, we're available on pretty much every other platform you could think of, all the big audio outlets, so iTunes, Stitcher, Aha Mobile. You can pull us into a Pocket Cast or whatever podcatcher you like to use. And if you don't like to use those, we have one for you. We have our own app available in iOS, Android, and the Fire OS. So no shortage of ways for you guys to catch up on all the Options Bootcamp goodness. This is your first program. If you're finding us for the first time, by all means, I encourage you to do just that. Go back, check out the archives. There's a lot of great stuff in there, a lot of great concepts that we touched on. And one of the great things about this program is, of course, all of this stuff never goes out of date. It's pretty much options education is options education. For the most part, maybe a tweak here or there, but really it's all pretty much current stuff. So you can go back anytime, check it out, and still get the same value out of it as the day we put it out. So check it out. We encourage you to do just that. And joining me on the program, as always, my bitter rival, the yin to my yang, the nemesis, the dark side to my light side, if you will, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the program, sir. Do you have your drill instructor cap and whistle ready?
Bwahaha, I sure do, as a matter of fact. Cap, check. Whistle, check. Combat boots, they're in the closet.
Well, 2 out of 3 ain't bad, so I guess that's enough for us to at least get the program started. So without further ado, let's dive right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir! You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir! Pull in, prepare to learn. Yes, sir!
Whenever I hear that, Dan, I always just get this uber patriotic feeling. I want to go light some fireworks and to see a 4th of July fireworks spectacular for whatever reason.
Indeed, I just lit off some firecrackers in my office.
Good to know. I'm glad you're feeling the spirit as well. And listeners, I hope you're feeling the spirit as well, because we got a great topic for you. Dan and I are always chatting like, what else should we discuss? What haven't we touched upon? And we actually touched upon this on another one of our programs on the network, and we instantly thought, this would be a great topic to discuss in a lot more detail on Options Bootcamp. So we brought on someone to help us do just that. You may be familiar with him from his myriad other appearances on the network from his own program. He does his own show every day at noon Central, 1 p.m. Eastern, right here on the Options Insider Radio Network. But you can also catch it on the TD Ameritrade platform. If you're a TD client, just head on over to the Swim Lessons Room. He also makes a few guest appearances every now and then on the Option Block, and once in a while even on Vol Views. He's all over the place. He's our unusual activity editor extraordinaire, as well as many other options educational caps. Mr. Andrew the Rock Lobster Giovinazzi. Andrew, welcome back. Actually, welcome back. Welcome to this program. I believe this is your first appearance on the old Options Bootcamp program.
It is. I think this is my fourth Options Insider show. Type of show.
You're getting there.
One for me.
Now you just need to become an advisor so you can do the advisor's options show, and then you need to become a futures options guy so you can do those shows. And then
we just got the advisory, so I don't know what I'm going to do now.
And then you need to fly down to the big conferences with me, like OIC next week, and we could sit down and we could do a bunch of interviews with like that, the heads of the exchanges and the heads of the brokerage firms. Then you could pretty much be on just about everything.
I could just hit every show, and then all I would do is just do radio shows all day long. Then I'd be you.
The world does not need another me, sir.
I was about to say one long is enough, but it is a pleasure to be on this show. It is a pleasure.
I'm trying to think if you've ever been on a show with Mr. P on my network before. I don't think it might be a first as well. So all sorts of fun firsts. 3 Italians on the same show. I'm not sure again. Again,
hey,
if the world,
you doing?
If the world,
hey, how you doing?
This is going to go off the rails quickly. I can tell listeners. Let me try my darndest to bring it back on track. What we're talking about today, listeners, is an interesting topic. You may have encountered this if you've ever put an option order through and seen what happens as a result, particularly if you get filled. We call them trade tags, maybe call them conditional tags or, descriptive tags that go up whenever these orders are actually executed. And they're, as you might imagine, a little bit more opaque than you might hope, particularly for someone to come into this space for the first time. You buy stock, you sell it, here's your print, here's the time you sold it at, here's the price you got filled at, and that's pretty much about it. Maybe there's some other, other pools it gets routed to every now and then, or other venues like that. It's about the extent, though, of stock fills, really, when you get down to it. Options, unfortunately, no. There's many, many different layers to how you can get filled and how these trades go up and what information is appended to them in an attempt, I say, because it's not really successful, an attempt to try to make things a little bit more explanatory for you as to terms of what actually happened, what actually went up, but it usually has exactly the opposite effect. It makes you more confused. So we decided there's quite a few of these, actually, and we started writing them up. You can find the whole article on our website, of course, theoptionsinsider.com. Just search for trade tags, and you'll find it. But we thought this was a good topic to really dive into on some level of detail here on the program as well. So, Mr. Andrew, you are our trade tag expert for the program. Are you ready?
I'm putting on my trade tag hat as we speak.
All right. I'm not sure what that looks like. Probably terrifying, so it's better it's an audio program. As we'll move on to the first tag, this one's kind of self-explanatory, listeners. What I'll do is I'll set it up for Andrew. I'll do the kind of basic definition you get from the broker. Then he'll jump in and kind of do, his translation of that for you, what he thinks that actually means. And then Mr. Passarelli will jump in with a joke or a song and dance routine, and it'll be a good show. You guys ready?
Or he'll throw a spear at it, something like that.
I'm already dancing.
He will say, I completely contradict that definition. Here is my own. And then it'll be a great back and forth Evans and Novak crossfire special. I'm looking forward to it.
Jane, you ignorant slut.
Yes. How dare you say that's what spread means? You fool. All right, here we go. We're going to kick things off with probably the most basic of them. We'll kind of start from most basic and go in order of complexity from there. Listeners, we'll start off with the tag that's regular, just like it seems, regular. And the definition of this you may get from your brokerage firm is that it indicates that the transaction was a regular sale and was made without stated conditions. Again, one of our more basic tags. Mr. Rock Lobster, anything you want to pile on to that definition, any translation you want to make for our listeners to make it more compelling, give them a little bit of a peek behind the scenes, if you will?
Well, my biggest thought is what makes a not regular trade, right? Everything you think like, why isn't everything regular? I'm buying them, I'm selling them.
Pretty much everything else on this list is not regular.
Exactly. So as far as a regular trade goes, the only thing I would say is what makes things interesting is when they are unregular, like when there's something strange with settlement. That's the biggest. So they can go up with a strange tag due to settlement or something that would upset the apple cart, so to speak, on how the contract. And it's really, that would be only I would call it like a pro or an institution type trade that has some sort of specific demand above and beyond what we're seeing on the other trade tags.
So there you go, listeners, kicking it off with regular, and again, we're trying to define these for you because at the end of the day, these can get pretty confusing. And also, that's why we do programs on our network, listeners, like our Unusual Activity show and our Odd Block segment on the option block, trying to divine the true intent behind what was going up on these trades, because the tags are really just the beginning, and quite often we joke that they're not exactly reliable. So when you see these tags, even after we explain them to you, take them with a grain of salt and really kind of do your own diligence. Listen to a program like ours if you're profiling one of the trades you're interested in, because we'll show you exactly how we do that diligence and how we analyze these trades using open interest, using implied volatility, using volume, and all the other fun stuff that we flag on a regular basis. And then with a little bit of extra secret sauce thrown in there, we try to arrive at the right conclusion. Not always successful, but we try our darndest. As we move on to our next tag here, this one is auto execution. The book definition of this one is the transaction was executed electronically. Prefix appears solely for information. Process as a regular transaction. Transaction executed electronically, solely for information. Only found in OPRA, that's the Options Price Reporting Authority, listeners. Options trades, and quite common. All right, that definition makes it even seem more confusing, Mr. Rock Lobster. So walk us through, what is your translation here of the auto execution tag?
Well, I thought this is interesting because it separates the paper executed floor from the auto X floor. And maybe trades going up on the New York Stock Exchange now, there still are floor brokers there. But with options, if you see 10,000 go up that go through the system, you think, oh my gosh, they're lifting all the liquidity that they can find electronically, meaning, to my mind, they couldn't really find a matching side, or the customer didn't know enough to find a matching side. So they just went through and swept all the liquidity they could find in rapid fire sort of machine gun style to run over all the liquidity providers. So usually when you see the auto X, it's because it's a more size trade, and they'll distinguish it from actually a broker trying to execute and put something up with the matching side. That's how I see auto X.
Yeah, kind of similar to another tag we'll get to a little bit later, intermarket sweep, but it kind of indicates intent, listeners, that these people are in a hurry to get filled and they want to get done. Usually a more sizable institutional customer as well. So someone who's in a hurry with some size institutional money, you may want to pay attention to that. Not always, because like we say on the network many times, size money is not always the smart money. But still, something you may want to pay attention to if someone's in a hurry to get done. Usually there's a reason for that and may be worth perhaps a little bit of investigation on your end. As we move on to our next trade tag here in our trade tag palooza, this one a little bit more straightforward, though perhaps not much as straightforward as you might assume. This is spread, and the book definition here of the spread tag is a spread between two options in the same options class. The transaction represents a trade in two options in the same class, parentheses, a buy and a sell in the same class. Prefix appears solely for information process, as a regular transaction. So, Mr. Rock Lobster, do your translation from Swahili into English, sir. What are we talking about here with the spread trade tag?
One of the biggest things about the spread trade, as I recall, and you guys might be able to remember this, is touching the book. Remember the old, can't touch the book, can't trade on the book because, there's an order in there. But with a spread, you could touch the book with a spread. Meaning, if there's an existing order in there and the trade trades at the price, the customer that had the resting order is supposed to get was the old priority. But if you have a spread, then the only way the trade goes up is both sides, and then the customer that wanted the spread done cannot be executed. So that was, I believe the spread tag went up as a response to things trading, touching the book, and they're like, well, wait a minute, why aren't I filled? And that's because it went up as a spread. Therefore, the trade wouldn't have been executed at all if it didn't go up as a spread. So that was one of the initial ideas. But what I've seen spreads go up as now is also tied to stock. So they're a little looser with how, so you'll see like 50,000 puts go up spread right now. And you look around.
Yeah, I hate that. I hate when they do that.
You know, you look around.
Spread to me always represents, it always represents another leg. So then I start digging through the book, or digging through the order flow. Where's the other 50,000 lot? Maybe it's broken up into a bunch of small lots, and it drives you mad when you find out that it's actually stock. That needs to be changed.
Into stock.
Just for our own sanity, people who do unusual activity analysis.
Yeah, exactly. Just for that huge portion of the population that does unusual activity.
All 5 of us.
It's just enough to drive you nuts. So that is the reason. So for some of you out there, they're like, okay, well, I saw this trading at my price, but I didn't get anything done. That's because the spread tag does alleviate some of that risk on execution, because you need both sides. That's I think one of the real reasons for it. But also when you see those contracts go up together, you know, if it's a combination, it's a risk reversal, it's a huge vertical spread, it's a huge time spread. The fact that, you know, that transaction went up tied to something else is important as well, because then you get a little bit better idea what somebody's got in mind when you actually see that it's some type of spread going on.
Yeah, so I just wanted to jump in and you know, kind of just take a step back for a second for the listeners and kind of be clear about everything we're talking about here. So a lot of people are often ask me about unusual activity, you know. They say, hey, you know, how do I use open interest and volume and blah, blah, blah for all this? And my standard response is, well, it's great to look at unusual activity. It's great to look at things that are going on in the marketplace. But, you know, one of the big problems with that is unless you really have all the fine granular details about the trade, you're probably going to end up tricking yourself. You know, some people just say, oh, look, there's big open interest in this call strike. That means everybody's buying calls and the stock is going to go up. You know, like that's a total jumping to a conclusion, if you will, and inferring something based on just a sliver of the information that's really available to you. So, you know, just kind of to take a little bit of a step back and point out what we're talking about. If you're really, really into unusual activity and you make that part of your option trading business, in order to be able to use some of the information you see, you need to take it several iterations further, and that's what we're talking about here. So this show, in my opinion, is very, very specifically geared towards the niche of traders that use they use unusual activity, and kind of giving you some clues as to how to actually make it work.
Well said, sir. I agree. It is definitely for the people who are using that, as well as I think people, every once in a while, someone's going to put up a trade somewhere, even the most basic guy, and see it come back with some weird tag on it, you know? And they're going to kind of scratch their head and be like, what the heck does that mean? And when you encounter that, listeners, that's what this episode is for. So when you come back, could be days, weeks, months, years down the road and say, what are those trade tags again? Hey, wait a minute. Here's an episode about all of that goodness. We've got you covered. So moving on to our next trade tag here. One probably sounds a little familiar to you if you've been listening to this show for a while. It's just straddle. We talked about that before. The trading definition, though, and the clearing / brokerage / opera definition of what they mean with a straddle tag, perhaps a little bit different. Their definition here is straddle between two options in the same class, a buy and a sell, and a put and a call. Prefix appears solely for information. Process as a regular transaction. Mr. Rock Lobster, walk us through the dark swirling mist that is the straddle trade tag, sir.
The dark swirling mist. Basically, straddle is two options in the same class, same strike, but different sides of the market, meaning call or put. So straddles are supposed to be buy or sell, same strike. So when you see calls go up in size and puts go up in size, you're trying to glean the intent of the buyer or seller, meaning they want to buy options or sell options. So as far as a useful trade tag goes, and Dan was, mentioning this, the straddle trade tag is one of the best ones because you're trying to tell if somebody's actually selling premium or buying premium, which I think is kind of a much more powerful signal overall than most of the other stuff. So that's kind of the key thing when you're looking at straddle. I mean, for an institution to buy a straddle, that's a huge thing to go in and buy a bunch of option premium like that, especially in a giant block like that, because they're really letting everybody know they want to do it. For the same reason, you sell a straddle block, that is a signal that you think, volatility is coming in, or the underlying's not going to move around a lot. So it's a pretty big signal for an institution to put out like that. I'm going to sell 2,000 straddles. That's not a small thing. And I'm not the only one that's looking at volume. All kinds of people are looking at volume. So it's I guess you kind of think about it like, you remember like the Nick Leeson, he was the big whale, right? And trading Nikkei futures. And the funny thing is this guy is sitting a kind of away from the floor, but everybody knew what he was doing. And everybody knew that, at least trading in the Japanese market, how loaded up he was getting on certain things. So, this volume does not go up in a vacuum. It goes up where everybody's looking. So like I said, the straddle, generally, it's a way to get a call and a put up at the same time. You can touch the book and off you go. So that as a trade, again, I think it's one of the better signals, even if they trade stock against it. I mean, a long straddle, a short straddle, even with a stock trade against it, is pretty much a bet on volatility and underlying movement. So it's sort of hard to disguise that depending on where they put it up.
Yeah, I like this one. You're right. It does provide a little bit more info than perhaps the other tags we're talking about, but we see it so rarely, so infrequently. I can probably count on one hand the number of times when we've been profiling UA recently, Andrew, that we've seen this tag go up. I mean, how often do you see it going up out there?
I mean, probably of the things I post, maybe 1 out of 20 tops, 1 out of 30.
Yeah, even that is probably, I would say, generous. You don't see it that often. So it is useful when you see it, listeners, because it does at least imply some sort of order to the transaction. Here's what kind of an indicator of what actually went up, which is unusual compared to the rest. So if you do see it, maybe dig a little bit further because it's interesting. Mr. Passarelli, anything to add to straddle or any of the other tags we just talked about?
Just offering, again, some outside perspective as well. You have to appreciate, too, that if you see 2,000 straddles go up, if you're a typical retail trader that listens to Bootcamp and is trying to get the basics on options, what does that mean to you? Well, it means that someone who trades a very, complex volatility arbitrage strategy is speculating on implied volatility. Does that help you in any way in selecting direction or anything? No, not at all. It gives you information about somebody's speculation on implied volatility or, gamma movements as well. But just kind of helping everybody, Mark said earlier, to take some of this stuff with a grain of salt. If you're a really high-speed trader and you do some volatility plays and that sort of thing, probably some pretty useful information to you. If you're somebody who, trades credit spread here or there, or buys calls or buys puts or does covered calls, that information is not relevant to you in any way.
There you go, listeners. So tune out completely. Do not listen to the program. This is a waste of everyone's time. All right, moving on to our next one here. Here we go. This one we see more frequently and kind of interesting for you listeners. This one is block trade, as the name kind of implies. This is an executed trade of a large number of shares, typically 10,000 shares or more. This is kind of referring back to the underlying a little bit here, so perhaps a little bit confusing for some of our listeners, Mr. Andrew, because this is an option show. So why don't you decipher that for them, Mr. Rock Lobster?
I think the biggest one is like a block trade can freeze things out. The old New York Stock Exchange rule was size takes precedence, where you could have a smaller order being frozen out at a price by just a big giant block going up. So it's a lot of these have to do with the mechanics of getting order flow posted. So one of the things everybody looks at when they look at an option screen is just making assumptions on how all that liquidity gets there. They look at, okay, I want to buy a stock or sell a stock. I should just be able to do it all the time. Or I want to buy or sell options. I want to go sell 50 of these or 100 of these. Why can't I do it? How come it's always such a pain in the butt? All these things. And the reason is all these contracts are literally they come out of thin air, as in the option contract doesn't exist till somebody opens it. So open interest tells you that there was a trade that was open, and a block trade is just somebody wants to move size into the market, and size into the market, size being a lot of contracts or shares, takes liquidity to accommodate that. And the old rule used to be size takes precedence. So again, it's another thing if you see a block, why it went up, or how come I didn't get to do anything when I have trading at that price. It's because, you know, in order to get these orders executed for the bigger volumes, the blocks match. So the trades, because you have to go through the trouble of a buyer finding a seller finding a buyer to get things up. So the one thing we got to understand about options and the equity markets is liquidity has to be provided by somebody. That's risk capital that's on the other side of every trade. So every trade you put into the market essentially the other side has been touched by a liquidity provider. You might trade with retail paper or another customer every once in a while, but far and away, most of the order flow goes into another liquidity provider or somebody that's using capital to provide risk. So a lot of these trade tags are just a way to describe how to get that volume in and out of the marketplace.
Well said, sir. Again, listeners, if you want to dive into this some more, of course, you can check out the article on theoptionsinsider.com. That was a pretty thorough investigation of block as we move into another one, kind of related to a trade tag we were just talking about a little bit earlier. This one is intermarket sweep, and the dictionary definition of this one is a trade resulting from an intermarket sweep execution order, so that's very self-explanatory, defining itself with its own name, due to a better price found on another market. Again, kind of related to what we were talking about earlier with the auto execution. This time you're seeing big moves electronically to really take up the liquidity across a variety of exchanges. Mr. Rock Lobster, what's your take here on intermarket sweep?
No, this is, again, the intermarket sweep is just letting you know they went through multiple floors trying to grab liquidity from everywhere. Nothing, I mean, it's a lot like AutoX. Sometimes AutoX, though, could be just one floor, not multiple floors. So they're just using the basically kind of the magic eye or the routing systems in these brokers to try to grab liquidity wherever they could find it. Nothing really super to add there on intermarket sweep. But again, it's an electronic order.
Yeah, it's kind of like the augmentations, like the AutoX on steroids to a degree, because they're hitting multiple exchanges almost simultaneously, listeners, to get liquidity. And this is someone who's really in a hurry to get filled, and he's got so much to do that he can't be filled at one venue, so he's gobbling them up everywhere. So that could also be indicative to you of some sort of interesting intent. Perhaps they just really want to get done, or perhaps it is too big to get filled at one venue. That's also possible as well. But still interesting if you're seeing these kind of trades going up in a name you're already looking at. It may be worth investigating a little more. Moving on to another tag that we see certainly less frequently than intermarket sweep. Intermarket sweep we see all the time. AutoX we see all the time. This one we don't see as frequently. This is combo. Similar dictionary broker definition to what we talk about in the trading world. Combo, of course, as we may have discussed on this program in the past, essentially is the synthetic underlying, so buy call, sell put, same strike, or vice versa, sell call, buy put on the same strike. And the book dictionary clearing / definition here is of similar definition. It represents the buying of a call and selling of the put for the same underlying stock or index. So they don't go as deep as to say same strike or anything along those lines. Again, appears solely for information, processed as a regular transaction. Mr. Rock Lobster, again, a little bit more of an esoteric trade tag. I know you and I have joked before about our differing definitions of what combo means to each of us as well. So walk our listeners through your translation of this trade tag, sir.
Combos. A combo, any literally quote unquote combination of a call or a put. So it can be just about anything. I'm going to buy out of the money calls, sell out of the money puts. Even a straddle can be a combo. Almost from the olden floor days, almost anything can be a combination. But the key was it was just a combination of a call or a put. Now we call them risk reversals and collars. Risk reversal being buy, call, sell, put, and collars being the opposite, buy, put, sell, call. So this is, again, another form of trade where the two legs are put together. And of course, one of the things, and I like how Dan was mentioning, you never know what is the position on the other side. So what you're trying to divine really is what is the intent of what this person was doing when they put a collar on? Because you could see, wow, they bought those puts and they sold those calls. But you have no idea that they might be long, 1 million shares of stock against the 10,000 line. And they're looking for protection. What it does tell you, though, is even if they are long, they are buying protection, which makes them makes somebody a little bit nervous about their position. So a position that they were once just long is no longer quite that size anymore. So, but that's what a combo is. Again, it allows the call and the put to trade together as a package, and book to be what we call put on the tape, or that's the trade going up on the ticker tape. Reporting through Opera.
Yeah, this is a scenario, which is kind of why I alluded to it earlier, where a little bit of options knowledge can actually hurt you in this sense, because you may have your own definition of what a combo is in the actual trading world definition versus what we're talking about here, which is quite a different beast. Mr. Passarelli, Andrew and I always joke about he has kind of this old school definition of what a combo is. What was a combo to you when you were on the floor?
Yeah, so I was a professional trader on the CBOE and on the board of trade, which is futures options. And now I work with a lot of retail traders. So there's actually 3 different definitions for each of those people. Like the nomenclature messes you up. Like one set of professionals will say that a combo is, the options portion of a conversion or reversal, where you buy a call and sell a put of the same strike or vice versa. Different group of professional traders will say that it's basically the option portion of a collar, sell a call and buy a put to different strikes, or vice versa. And then I've heard some retail traders refer to a strangle as a combo, which is one that I just simply don't get. To me, that doesn't make any sense.
That one is disallowed instantly on this network.
Yeah, that's kind of silly.
You, as their mentor, sir, have a duty to break them of that forcibly if necessary.
Right. And so either way, with either of the professional definitions of a combo, whether it's, buying a call and selling a put, same strike or different strike, either way, you're getting a big delta trade. And if you see a bunch of these combos go up, well, it means one of 2 things. And let's just look at it from a bullish combo where somebody's long the call and short the put. Same strike or different strikes doesn't really matter. What that means is either let's look at it from the perspective of a short combo, a bearish combo, just because I think it's easier for people to visualize. So somebody's long the put and short the call, same strike or 2 different strikes. So that means one of 2 things. It either means they're bearish because they're taking this big delta trade that is bearish and has a negative delta, or it means they're bullish and they own the stock, but they're a little bit concerned about volatility, so they want to hedge. Or I guess it could mean a third thing. They're really not sure, but they're afraid of volatility, so they want to hedge. So there you have it. Basically, it means the person doing this thinks the market is either going up or going down or could be volatile and really isn't sure.
There you go. And just for the purposes of clarification here, since this is my network, I get to decide, and the only definition of combo that is allowed, that is legitimate on this network, is the synthetic stock portion, the call put same strike. All these other old school ones you want to throw at me, Andrew, those are completely disallowed. So just so you know. So all you guys who were market making in 1972, I have no interest in your definitions.
It has been.
I say on almost every options insider program, I take umbrage to that, sir.
He does take a lot of umbrage in his time on the network. You have it easy by comparison, Mr. Passarelli.
You can never have too much umbrage.
That's true.
Umbrage.
All right. Before he overloads with umbrage, listeners, let's move on to our next trade tag here. This one pretty straightforward, certainly compared to that last one. This is cancel, and as you might expect, the transaction is the last reported for a particular option contract and is now canceled. This is actually an important one because we'll see this go up quite a bit, and sometimes if you don't notice it right away, you may do a lot of analysis or homework on a trade and then realize, wait a minute, this whole thing, all of this work is for naught because this trade was busted. Mr. Rock Lobster, pretty straightforward one here. Walk us through your variation of cancel, what you guys were talking about on the floor in 1962 there.
Yes, and in 1962, we used to call that was a DK, meaning,
yeah, yep.
You think you have a trade, The broker thinks he has a trade, but you were like, what? I was over there talking to, the clerk. So I don't know that trade. And that's sometimes what happens. A trade is.
That would be a great trade tag, DK. That came through. Yeah. I would love that. I would go crazy for that, but they don't allow that.
It was DK'd. I mean, I don't know it. And generally, as Dan, and you probably remember, as a market maker or a broker, you don't want to have a lot of DKs because then people would stop trading with you. Because it's like, well, what's he going to say today? Is he going to know it or not? So generally, that is something that was rarely used, or a broker would come to you and saying, listen, I have an error, meaning somebody wrote something up wrong. The customer had second thoughts, whatever. Generally, within a couple seconds, you can bust a trade, and that's generally what happens here. They're busting the trade and on their way. I have seen canceled trades, though, when the electronic market making was relatively brand new. I remember, I think it was Citi through a Shearson or something. They had an electronic market making operation, and somebody did something very bad and executed about $50 million worth of contracts in error. And then they were trying to get all those canceled. And it didn't quite work out, because the other market makers were basically like, you know what, your system, you guys just screwed up. Tough beans. And they didn't let them out. I also remember that on the PSC once, somebody tested the system, and they thought they were running in the test environment and not in the live environment. So instead of testing with 1 lots, the guy tested with 10,000 lots. So all of a sudden, everything, all these names from like A to F, redlined on volume, because when he put the order in, he jammed all these orders through the system. So immediately everybody's screens got lit up. Like, why is somebody paying all this money for all these options? And we realized it was just some functionary or whatever in the back. A programmer made a mistake trying to test the system.
Dan, I didn't know you worked on the Picos, Dan.
What?
Raking him up, giving him a hard time.
He was running systems on the Picos, did you?
I didn't know you were running system tests on the Picos back in the day, so you never told me about that.
And as I recall, it's like, oh my God, really? So it just, so anyway, there's lots of reasons, in short, why trades can be canceled, like the flash crash and stuff like that. So all kinds of reasons why trades can be canceled.
The thing that drives me crazy about cancel, you probably see this too, Andrew, is, when these trades go up and then they're busted, so they're canceled, so they're kind of busted. But for some reason, they still hang out in the volume numbers for that day, or for whatever reason. It can be really screwy. It screws the numbers. It makes that day's activity seem all wrong. It gives you a whole sense of the ADV being off. It's kind of annoying. I don't know if some platforms still do. I guess they can't pull out the volume. I don't know why, or do it in a timely fashion. But so if you see us going up and you still see the numbers for that day are kind of wonky for whatever reason, listeners, it's because the trade got canceled, and for some reason it's that volume is still being reflected in the day's volume. It's an annoying legacy issue on some platforms. You may encounter this as we move on to our next one. This is actually the one that kind of got the whole ball rolling. We talked about this on one of our other shows, and it kind of led to an interesting discussion, and some listeners wrote in with a bunch of questions. People were kind of confused about this one, so that kind of led to discussion about this one, which led to the whole ongoing trade tag dialogue that we're having here today. This one is SoldLast, a little bit more of an infrequent one. We see it certainly more than combo up there, but still not as frequent as like an auto X type of thing. This one refers to a trade that is reported late, and the quote last sale is reported as the price. The last sale price represents the last price paid for an option during the trading day. It's usually an administrative message. This one is confusing for a couple of reasons. Number one, the fact that it implies a sale right there in the name of it. So people see this, and on first blush, their assumption is, oh, well, this means this trade was sold at some price here, this last price, something like that. And Mr. Rock Lobster, that's not necessarily the case, is it?
No, it is not. It is it's normally what happens is basically something is going up, but it's not getting reported in a timely manner. And the thing is, so you see this huge block go up, but it might have been posted somewhere else. And that's the confusion on all this thing, where the last sale price was, okay, let's say we have something, the last price on the day, for instance, might have been $2.25. Yes, yet there is a price that is reporting outside that range for whatever reason. So they came up with a trade tag. It seems like to me, this is sort of a way to just fix trades that sort of go up out of sequence. It's giving the exchange a little wiggle room in case things aren't going up somehow in a timely manner, or for whatever reason that you could have those sort of problems. It's kind of a quickie fixie thing. That was always my sense on that type.
They should change it to quickie fixie. I think that would be far more self-explanatory.
Exactly.
Quickie fixie order. Watch out. Similar to this one, this kind of happens more than you might think, listeners, or these trades going up, at least the prints going up out of sequence or late. One of the reasons why we say these trade tags are sometimes a little bit confusing. This next one is kind of similar to the last one, and this is price variation. Similar theme, something goes up out of sequence, or the price is not in what's going on right now, or the order, the sequence that is the things are being traded in right now, and so they need to adjust it. And this one, the definition is essentially it occurs when an option trade goes up tied to a stock at a different price, so the options prices are adjusted. The NBBO, as a national best bid and offer, listeners, that's reported with the price variation is unreliable, as the exchange either prints it late or it's tied to stock at a different price. This really goes up for customers so they don't see this trade and go, hey, how come I didn't get filled at these prices? Which happens quite a bit, listeners. You would be surprised. Mr. Rock Lobster, walk us through your translation here of price variation.
Aha. The price variation is the thing they invented so they could also place this with an underline. So you could, because the biggest thing with price variation is you've got, let's say, stock that had to print in another place in order to get the stock up. They have to adjust the option prices because normally it's a package. So when you put on a buy right, you want to trade it for, let's say, $1.50 over parity, something like that, where you have kind of a limit. But if the underlying moves around, then you have to change the option price. So the price variation is just, again, another tag for them to put up a trade and still be able to get the trade placed, but not get if people get traded through, they're saying this only happened here because this was tied to stock. So it gives people again, another excuse to sort of wiggle out of any problems they might have with the NBVO, which is the National Best Bid and Offer.
Yep, another little get out of jail free card. You see one of these tags go up with a trade and the prices don't make sense. That's probably why, is that they were making it up to them on some other leg and went about a sequence, etc. So this is just a kind of a flag to the customers. Hey, don't get mad at us. You can't get this price if you traded this right now. This was a special case, and it went up in a little bit of a weird scenario. As we move on to our final name, at least for now, maybe we'll come back with others down the road, but at least for now in our big trade tag rundown, this one, another perhaps confusing one if you're familiar at all with options. This is the buy right trade tag. Of course, when you think buy right, listeners, you think, of course, a covered call trade. Not exactly what they're talking about here, although it's related. The dictionary definition here they're referring to is an option trade tied to stock on some ratio. Again, tied to the underlying being a big theme here. For the options to trade, a block of stock is crossed from customer to trader. So not just the typical covered call you may be assuming, listeners. Mr. Rock Lobster, take us home here on the buy right trade tag.
The biggest thing now with the buy right trade tag that I've seen more and more, and it's a stuff when we're doing I'm doing oddities, you're seeing more and more buy rights go up, but it's not a customer buying stock and selling calls. It's a customer buying put, buying stock, or tying any stock trade with any option trade on a ratio. So normally sometimes now when you see buy right, it could be tied to stock on a ratio. It could be a put in stock. Generally, though, I don't see the pricing go up as like Texas style, meaning I'm going to buy calls and I'm going to buy stock. Normally, it's one side of the market and another side of the market. And again, it's another tag to let you know things are trading at a price, but it's also connected to something else, which means it might be trading outside a price for you.
All right. Thank you for that, Mr. Rock Lobster. Now, because I want to make sure you guys get some time to shine on the old program, without further ado, we're going to dive right on into the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. This is indeed the portion of the program where you guys get to take the reins and sound off with your questions, your comments, your insight for us as well as for your fellow listeners here on the old program. We're going to kick things off. We got a lot of questions, see how many we can get to here in the time remaining. This one comes from Mr. or perhaps Mrs. Vegan. They write, what oil products do airlines use to hedge their crude exposure? Mr. P, when I think of the black tar, the Texas tea, I think of you. So what do you have to add here for our friend, Mr. or Mrs. Vegan?
Sure. I mean, probably a lot of different things. First of all, they're big institutions, so they may very well and probably do use over-the-counter swaps type trades. In fact, I know that for sure to be true. But even on a more basic level, I mean, one of the obvious things they do is timing. They're buying petroleum products, probably try and buy it when it's cheap and store it, and, not buy it when it's really expensive. And then, I mean, they have access, of course, to over-the-counter, to exchange listed products too. Simple like, crude oil futures and all that kind of thing. But I think with some of these really, really large organizations, institutions, if you will, I think they do a lot of over-the-counter swap stuff that you never see. What ends up happening, though, is sometimes the over-the-counter swaps guys end up laying that off in the listed market. So, maybe if you see a bunch of oil futures go up by somebody, it may not be an airline doing that, but it might be a really big trader who traded with the airline and is laying off his risk in the futures market.
Well said, sir. And unfortunately, far fewer airlines do that than you might assume. I mean, back in the day, that was Southwest's big advantage. They were one of the few that really hedged their skyrocketing oil costs and allowed them to do a lot of other interesting initiatives that let them stay competitive and get a lot of market share. So it's surprising to see that even in this day and age, I think maybe some of them have awakened to that fact now. And certainly with oil prices down here, if these guys aren't hedging, then they're fools. All right, next up on the old mail call, we have a question from Alan. He writes, why is rolling a position so prominent? Isn't that just averaging into a losing trade? A great question, Alan. We've discussed rolling and adjustments myriad times on this program. We have several episodes devoted to it, as well as on some of our other programs on the network. But you're also right. We do see people kind of getting into a bit of an over trading scenario with adjustments where perhaps they're too quick on the trigger to roll. See this a lot with covered call traders. We talk about this all the time. You buy a stock, you write the call, you ostensibly pick a strike where you're happy having the stock called away. It gets close to it, and they're jumping on the trigger finger, ready to roll, ready to lock in losses on the covered call portion, and then the stock never goes anywhere again, and all these other problems we see quite a bit. So I do see where you're coming from, Mr. Allen, even though I would say in all scenarios, rolling is certainly not a loser from a long-term perspective. Mr. P, you spend a lot of your time with your mentees discussing adjustments and rolls and things like that. So what do you have to say to our friend here, Mr. Allen, who takes a bit of a dim view on rolling in general?
Yeah, Alan, well, you've probably, if you're a regular listener to the show, I mean, you've heard me say that, it is true that a lot of times adjusting is overused. However, the fact of the matter is that you're going to have winning trades and losing trades. And when you have a trade that has gone against you, you have lost money. And every once in a while I get a super novice trader that says, wait, I didn't lose money. I didn't close it and lock it in, but you've lost money. Go ask your broker for a check. If the trade goes against you and you're down in your account, you have lost money. So the point is, what do you do from there? Do you just close the trade, which can be fine, close the trade and take the loss? The worst thing you can do, obviously, is just to hold on to the loser and cross your fingers. That's a terrible idea. But instead of just simply closing the trade and locking in that loss, one thing that people can do is roll down or up, roll to a different strike price, which I think is at the heart of what you're talking about specifically. And what that does is it gives you a higher probability of being successful, taking a losing trade and doing one of two things: changing it into a trade that either has a higher probability of success than the one that you originally had on, or maybe bringing in some extra premium so that you could, if not take the loser and make it a winner, at least take the loser and make it a smaller loser. So, I mean, it's a defensive strategy that under the right set of circumstances can make a whole lot of sense. I agree with you in, hey, let's not overuse it. But, you know, I mean, the question is, do you want to lock in a big loser, or do you want to take that big loser and maybe try and make it a winner, or maybe try and make it a smaller loser? That's really at the heart of the answer here.
Indeed. Well said. Mr. Rocklobster, anything to add? Of course, Mr. Allen also kind of overlooking the fact that sometimes you see people roll winners. They're playing with house money and they want to keep that trade on. So there's not all rolls are losers. Is that not correct, Mr. Rocklobster?
That is definitely not correct. All rolls are not losers. Some are rolling quite big winners, as we have seen, taking their like $1 million and trying to make $2 million. So the most important thing for rolling is you need to have an end point for the roll. I can see you want to roll if you want to buy stock, like if you're selling put spreads or puts and you want to buy stock and you roll it down a little bit. But there has to be a point where you stop, or you're just going to keep rolling money until you don't have any. So the most important thing is just have a plan and stick to it no matter what happens. That's key, because you can get caught up in thinking, oh, it's going to turn around any moment, and it doesn't.
How often, Andrew, have you seen people write in with, here's my trade, how does it look? And it started off with some clear plan, and then there was a roll here, an adjustment here, and then he added this leg here, and then it became just this hybrid Franken monstrosity that meant nothing, and it was just a lot of work to do nothing at the end of the day. The broker loved it because you generated a lot of commissions, but you didn't really get what you wanted there. So yeah, I can sometimes see what Alan is referring to there is sometimes the over-trading, over-adjusting mentality can get a hold of you. But I wouldn't come to that with all rolls are equal bad, Alan. Certainly far from it. There are many times when you want to roll, including when you're playing with house money and you want to keep the party going. All right, moving on to our final question. It seems appropriate given the theme of this episode. This one comes from Angus. He writes, maybe this is a basic question, but where do the names call and put come from? What about straddle and strangle? Since we're talking tags, we're talking themes, seems like a good one to go out on. Mr. Rock Lobster, we'll start with you. What do you have to say here for our friend, Mr. Angus?
I think it had to be the initial call and put terms were relative to what you did with the stock. Like if you owned a call, you could call it away from somebody. And the put is you put the stock to somebody, meaning call, I can take it away, and put, I'm going to give it to you. Those are the initial ones on those. As far as straddle and strangle, or even front spread or back spread, I am still at a loss. One thing I probably should do is try to figure out where all these terms have come from, be a little bit more of an option historian, but straddle and strangle, I do not know where I can guess, but I do not know exactly where the terms came from on those ones. I know what they mean, but I don't know the exact genesis. Lost
in the sands of time. Dan, I've always thought of it this way. I've always thought of straddles. I can kind of see that. You're kind of straddling the fence. You're not sure which way to go, so you're long. You want it to go either way. You're kind of straddling the line there. Strangle, I always think of it in terms of like a short strangle, because you're kind of strangling the underlying. You don't want it to go anywhere, and you're on both sides of it, kind of squeezing. So I see it from that way. How do you see straddle and strangle, Dan?
Yeah, I mean, in discussions that I had, I'm sure I had these discussions early on, when I was first learning options too, like with, back when I was a clerk, talking to other clerks, like, where'd they get that crazy name from, But yeah, that's kind of what I ascertained too, like straddle, it's pretty clear, like you got one on one side, one on the other. You're straddling it, and strangle, right. I was told by someone that it was from the short side where like, yeah, you're trying to constrict it to be within this area, But yeah, they sure come up with a lot of wacky names for a lot of this stuff.
Yeah, because you think long strangle doesn't really make sense because you want it to roll, then you want it to go. You're like fly free, go as far as you can. You're not squeezing it at all. But short strangle, you're like, oh, stay put, don't go anywhere. Yeah, it's a little bit confusing. One's long premium kind of definition, one's kind of short. So yeah, it gets all over the place. But it's not. Don't feel bad, Angus. We don't shame you for that question. Options terminology, much of it is lost in the primordial ooze of the options world, and we still use it today. We had discussion all the time with front spread and back spread. I hate those terms. So there's a lot of things that are kind of have their origins and the murky sands of time from an options perspective that really aren't applicable anymore today, yet we still use them. So don't feel bad asking these types of basic terminology questions. And unfortunately, that's all the time we have for the mail call segment today, but it was a fun episode. I think we did some good work today. We really busted some options myths, maybe addressed some misconceptions. But before we go, as always, I want to check in with each of my cohorts here, my fellow drill instructors on the old boot camp show. And Andrew, since you are technically our guest today, you get pride of place. What's cooking in your neck of the woods until the next time we can all gather together here on the old Options Bootcamp program?
I feel honored. As far as what's cooking at Option Pit, we just had our weekly event. So we will be coming up with the next Saturday event in June. I believe we will have that date for you. I think it's going to be mid-June. But our Saturday events are popping up, and it was all about weeklies. So if you want to understand how to use weeklies in an intelligent way to structure trades, surf on over at optionpit.com. And if you poke around, you can look in our store and start to buy some of these great webinars that Mark and I put on. So it was a great webinar, well attended. People liked it. So of course the trade ideas are pretty decent. So that's basically what we got besides all the other normal stuff we got going on over at Option Pit.
A weekly event about weeklies. I like it. Might get a little bit confusing though when you do a weekly event about leaps.
Actually, what is it? It's a monthly event about weeklies.
Oh, okay. Monthly event. That's even more confusing. I love it. Good stuff. Good branding. Not confusing at all. Good stuff. Exactly. All right. And Mr. Passarelli, we're flipping the other side of the script for you now because I know you're talking longer term. You're talking your big, mega, spectacular event out there in the vineyards of the West Coast, which I am very happy to have received the full free freight to and the wine train, all that fun stuff. Very generous of you, sir. So by all means, what's cooking with the big market taker event?
Yeah, we are kind of wrapping up, accepting the final stragglers of people who were thinking about coming out to Sonoma to meet us. This is kind of the last chance because we've got to turn in our list of people to the winery and to the hotel and all that. So, our block of rooms, our discount block of rooms, is disappearing as well. So. Last chance, anybody interested in coming to our annual options retreat in Sonoma Valley, California this year, which is on June 12th and 13th, go over to markettaker.com/Sonoma, and it's your last chance to register. We would love to see you. Hopefully we get to meet some of you guys out in Sonoma Valley.
Should be good stuff. Talking options, maybe some pairs trades with some wine pairing, all sorts of good stuff. See, I'm doing all. I got Andrew's branding down. I'm getting your branding. I'm doing all the work for you guys. You guys just show up. All right, check it out, listeners. Markettaker.com/Sonoma to learn more. And while you're there, of course, play around. Click on the site a little bit. Check out some of the other stuff they have there. They have the newsletter. Sign up for the newsletter. Check out his mentoring and courses and all the other cool stuff they have cooking over there in Market Taker land. And on behalf of Dan and Andrew, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in such great questions. We got so many of them. We'll try to get to more in the next episode, and of course we'll see you next time right here on Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.